Tom Bowley, Chief Market Strategist here at EarningsBeats. Hey, good morning, everybody, and welcome to this Wednesday, January 17th edition of Trading Places Live at EarningsBeats.com. I'm Tom Bowley, Chief Market Strategist at EarningsBeats, and I'll be your host for the next 30 minutes or so as we prepare for the next market open. We did get a nice retail sales report coming in just a little bit above expectations. We saw retail sales rising about 0.6% this morning. Market was expecting 0.4%. And if we strip out the vehicles, retail sales were still up about 0.4%. Market expecting 0.2% rise. So overall, got some decent news there. But all the market futures I was looking at just a minute ago, and I'll give you that here. Let's go ahead and go over that. All down this morning. We've got the Dow Jones Industrial Average down about 0.5%. Then we've got the Spider, which tracks the S&P 500, down about 0.6%. The QQQ tracking the NASDAQ 100 down 0.9%. And the IWM, which continues to take the brunt of the selling, down about 1.5% this morning pre-market. And that, if you've been watching the IWM, this has been kind of a constant for about 2.5 weeks now, where we're seeing a lot of movement at the opening bell to the downside. This morning, the IWM down $2.88 to 187.96, getting pretty close to that mid 180s area, where I believe we're going to find some very significant support on the IWM. It'll be interesting to see whether or not that area holds. But once we lost gap support, seemed to me like there really wasn't a whole lot of support until we get back into those mid 180s, and we're almost there. So not a great start to the day. Of course, we've been talking about this quite a bit, the fact there are a lot of short-term warning signs that we at least need to be aware of, and some of those have been playing out certainly in the small cap area, and it might just be flipping over to the larger cap counterparts as well. Let's go ahead and jump into the action from yesterday. So yesterday, Tuesday, of course, we had a holiday on Monday, so this is a holiday shortened week. We do have options expiring on Friday. We've got the most bullish period in the calendar year ending. That'll be tomorrow. So remember the October 27th close to the January 18th close. That is the most bullish period of the year. Historically, that period has seen rises 63 of the last 74 years. So a very, very high percentage. This past year has been no exception. In fact, we have seen one of the strongest October 28th to January 18th periods on the S&P 500 and on the NASDAQ since 1950 on the S&P and 1971 on the NASDAQ. So it's been a very, very strong period, but there are signals telling us that we got to be careful here in the near term, and I think we're seeing some of that play out. The Dow Jones Industrial Average yesterday down 0.6%. S&P 500 down 1/3%. NASDAQ down just 1/100%. So basically flat. And we'll talk about technology, but that was the primary reason. Mid caps down about 2/3%. Small caps down 1.25%. Transports down 0.8%. You can see all the major indices still trading above the 50. The first three I talked about, the Dow, S&P, and the NASDAQ 100, all at or above the 20-day moving average. Mid caps slightly below. Small caps now approaching the 50-day moving average because of that relative weakness that we've seen here over the past couple of weeks. Transports actually testing that 50-day moving average. So you can see, depending on which area of the market you're looking at, a little bit more deterioration than in others. Among the sectors, technology actually rose yesterday about 0.25%. It was the only sector higher yesterday. The other 10 were down, led by energy, which was down 2.38%. It is rapidly approaching key support down at around 80. And then we've got materials falling back below the 20 recently, 20-day moving average, approaching its 50-day moving average as well, dropping 1.15% on Wednesday or on Tuesday. And the semiconductors, that's where our strength was. So if you're wondering, okay, what held up technology? What held up the NASDAQ? It was clearly semiconductor. Semiconductors up another 2%. We're seeing another big move continuing in NVIDIA. AMD's been strong. A number of these semiconductor stocks have been popping, breaking out to new highs, and that has been certainly helpful to this index and to the NASDAQ 100 in general. But this really and truly has been narrow leadership on the NASDAQ. NASDAQ has not been able to break out even with that strength from the semiconductors. And of course, as we've talked about in recent shows, I've been writing about it. The much lower PPO is very notable, especially since the S&P 500 went up, tried to take out the all-time high. NASDAQ went up, tried to take out its December high. Both are failing so far with a much, much lower PPO. So that tells me that the momentum to the upside is slowing. And if you try to make a breakout and you can't get through, or if you make a breakout and then have some sort of reversing candle, those can be some pretty ominous signs in the near term. And when I talk near term, when it comes to daily divergences, I'm talking about 1 to 3 weeks. So just kind of give you an idea. Maybe this takes us, maybe it's just the next week through options expiration into next week, or maybe it takes a little bit longer and we go through the rest of January perhaps and into early February before finding a short-term bottom. But, barring a breakout with heavy volume, I think we got to be a little cautious here. To the downside, in the materials group, aluminum took a big drop yesterday, down 7.2%, falling back down below its 50-day moving average. Looked like we had something in the second half of December to the upside. Nope, right back down below the moving averages. Certainly appears now that we're trying to get back down close to that 80 low that we saw all the way back in October. Aerospace in the industrials, also struggling to hold 50-day moving average, failed to do so, and the PPO about to turn negative. And this group, you can see the 50-day is at about 1714, and we closed at 1672. So this was a very, very swift move back down below that 50-day moving average. And keep in mind, a lot of folks are saying, interest rates are going to be cut and everybody's starting to turn a little bit more dovish. The stock market looks ahead. So if you're wondering why we had such a huge fourth quarter rally, or maybe why we had such a big 2023 in general, especially on the NASDAQ, it was because the market was pricing in the Fed pivoting and turning much more dovish. Look back to the cyclical bear market in 2022. Much of that selling, much of that bear market was over by the time that first significant interest rate hike was taken in by the Fed in May of 2022. Most of the selling was already in. So, yes, interest rates, I believe, are coming back down, but a lot of that has been priced in, and that's what confuses many traders. And then traders get bearish because the market goes down when, in fact, it was simply some profit taking because of it was more of a sell on the news kind of a thing. I think most everyone now is anticipating that the Fed is going to be cutting at some point in 2024. Some are saying as early as March. I'm still thinking it's going to be June. But regardless, the Fed is going to be in a much more dovish state throughout 2024. And I think the market has already priced in some of that. Maybe not all of it, but certainly a lot of it. And we'll see where we go from here. But I would not be surprised, as I've been saying, in the short term. I don't want anyone to be confused out there. I'm bullish. I'm talking about the end of the year, 2025, 2026, 2027. I'm bullish. We'll have corrections. We may have another cyclical bear market along the way, but I am overall bullish. I believe the market's going higher, and I think you want to be in on the long side for the long term. That should be your overall long-term strategy. At least it's mine. You can decide for yourself. But in the short term, market goes up and down all the time. And being able to book your profits as a short to intermediate term trader is really important. Otherwise, any profits that you made in the fourth quarter simply start eroding if you just hold on the way back down to the same degree or to the same things that you had on the way up. So I like to, try to throw in a little bit more aggression when I believe the market's rising. When I think it's cautious, perhaps going to pull back a little bit. Even if it goes higher, I'm still in the market on the long side, but I'm not leveraged. My positions are much more maybe value oriented, a little more so than usual, just in case we get that big hit, especially in areas like technology. So that's the way I see it right now. I think the rest of January is very dicey. Again, I'm long, so if the market goes up, great. But I think you got to be careful in how bullish you are at this point, because I do think short term we could have some issues, given those divergences, given a lot of things, rotation that we saw more toward value in the fourth quarter, but and also the election year, the presidential election year. We know historically first quarter tends to be quite choppy. January is not a great month for these presidential election years. January tends to be a pretty decent month, especially on the NASDAQ historically, but that can be a problem in presidential election years. So all of that, there's a lot of pieces of this puzzle that come together. I would just say at this point, short-term cautious, long-term bullish. Let's move on to the 10-year Treasury yield. We did have some earnings reports out. As I said, well, the big one out already is the retail sales number, which did come in a little bit above expectations. December industrial production. This is a number that I'm going to be watching pretty closely, the industrial production numbers, because our last 3 or 4 significant bear markets or significant recessions, I should say, all occurred with very weak production numbers, industrial production numbers. And so this is something I'm going to be watching in 2024. If we don't get those weak industrial production numbers, start seeing a pretty significant drop, then I don't see the recession coming. I think that would be one key that I would need to see personally. And then I need to see some rotation in the market. But we're not really seeing any of that at this point. So I'd be a little cautious about calling too many economic woes in 2024. I'm just not seeing that at this point. Also, capacity utilization will be out with with those industrial production numbers. November business inventories will be out a little bit later this morning as well, and also January housing market index. So we'll get another housing report. We got a couple more housing reports coming out later this week as well. Got starts and building permits, and I think existing home sales later in the week. So we got some more housing numbers, and housing has been the best. During that run up from late October to the end of the year, housing or home construction, home builders, that area was the strongest area in the market. So, and historically, seasonally, November, December, January are the 3 best months for that area. So not only was it moving up because of interest rates dropping, but that group was also moving up because of history. I mean, it was following its historical pattern, which was to produce most of its gains November, December, January. January's only got a half the month to go. This is a group personally that I think if you've been in and you've made some nice money, I would at a minimum be pulling back on how much I own. And I would be okay actually being out of home construction, because I do think short-term interest rates probably are going to moderate here in the 390, 410, 420 area, maybe back up to this 50-day moving average right here. You can see on the TNX. Right now, that 50-day is at 419.3, so 4.193, and that will continue to drop. So today, let me give you the update where we are right now, 409.8, so pretty close to that 410 level. We're up another 3 basis points today, probably because of the stronger than expected retail sales number. So we got a little bit more room to the upside before I think we see a pretty significant test. Also, when we broke down below the 411, 412 area, notice that was on a pretty big red candle, and it all started from about 420. So 420, 419, I think that's the area to watch to the upside. If we break out, we could be moving to a higher range in the 10-year Treasury yield, which in turn certainly could produce some selling in stocks. So watch that as well. I suspect that we're going to probably be in a range from about that 420 level down to the recent low at 380. I think that's going to be a range that we stick in for a little while. Let's see. Let's keep moving on. S&P 500. This is the divergence I've been talking about. If you're new today, welcome. But here we've been trying to break out on the S&P 500. But in doing so, you can see the PPO is not even budging to the upside. In fact, yesterday when we saw a lower close, we actually ticked down to a new recent low in the PPO. So the PPO, if you're not familiar with it, this is a look at two moving averages, two exponential moving averages. So you can put in whatever you want, but the default is the 12 and 26 period exponential moving averages. And on a daily chart, that's going to be 12-day and a 26-day exponential moving average. When prices go up, what you expect is for the short-term moving average to go up faster than the long-term moving average. I mean, that only makes sense because as prices move up, it's going to impact a moving average that only has 12 days faster than it's going to impact a moving average that has 26 days. So what you see anytime you start a really nice trend to the upside, you start to see that PPO rise, and it can rise pretty rapidly depending on how fast you're going up. Well, we know November through December, we went up pretty fast. It was one of the strongest 2-month periods that we've seen this century. Not just, this year, this century, going back 24 years. So this has been a really, really good move. And all the way up, you can see that PPO kept strengthening as we kept moving up. But once we hit this last high in December, you can already see the S&P looked like it was tilting, maybe a little teetering to the downside on that PPO. Once we went back down and tested the 20, which is where we normally find support when momentum is building, we hit the 20, we bounced like we would expect to, but on this latest move, that PPO hasn't budged. So what that means is that 26-day moving average is catching up rapidly to the 12-day. The 12-day doesn't have enough momentum to pull away from the 26-day. And as a result, we're seeing this PPO post what would be a negative divergence. Now, technically, it looks like maybe we did get a higher close because the PPO, the MACD, if you follow the MACD, they're all based on closing prices, not intraday highs. So here the closing price was 47.83. I think we did, we closed right at about there, maybe just slightly above it. So technically, we did have a negative divergence. We had a very, very slight close above where we closed in December, and with that, a much lower PPO. So technically, there is a negative divergence in play on the S&P 500. And what that means to me is once I get a negative divergence, and this is just my style strategy, when I see negative divergences just based on history, I expect a PPO reset, which means the 12-day and the 26-day moving averages will be equal. Right now, the 12-day is still above the 26-day, right? That's why the PPO is above the zero line. I believe we're going to go back to the zero line. That's what we typically see with negative divergences. And that resets the PPO at zero. When you're at zero, there's no momentum either way. I mean, what that zero line represents is that your 12 and 26 period EMAs are exactly the same. There's no momentum. I mean, if you have two moving averages of different lengths or different time periods, and they're exactly the same, there's no advantage one versus the other, short term versus longer term. So at that point, there's no momentum. That's what I consider a reset. And from there, the market can do whatever. It could bounce back up. It could go through. It's kind of achieved what I look for when we get that PPO centerline test and or 50-day SMA test. So I look for both, but either one, or if you approach either one, to me, I mean, it's not an exact science. I'm not looking for exactly zero and exactly the 50-day moving average, but I do watch for stocks to start to gravitate. So when I get the negative divergence, let me first say, negative divergences, just like anything else in technical analysis, does not work 100% of the time. I don't know what the percentage is that it works. I would say it works more than 50. I don't know if it's 60, 70, 80. I haven't done a study on it. But what it tells me more than anything is that risks are elevated. Too many folks look at technical analysis and think, I want technical analysis to tell me what's going to happen. Give me the guarantee. Where's the market going? And anyone who thinks that is going to get disappointed with technical analysis really quickly, because it doesn't work that way. It's not 100%. You have a lot of different signals that technical analysis will provide you. You got to put them all together and then figure out what's the risky part of trading right now. Is it being long or is it being short? Or, should I be in cash? Or is being in cash the risky? Should I be long instead of cash? Those decisions need to be made based on a risk analysis in the market. And so when I see negative divergences, immediately it's a red flag. I mean, it's a secondary signal. Price action, volume, price and volume will always be my number one. I mean, if we break out above 4,800 and we have a massive volume day, I don't care about this negative divergence. I want to be on the long side. Now, somewhere down the road, we might get the reversing candle with that negative divergence, and that could be a signal of a reversal. But I never mistake my number one primary indicator, and it's not close. Second isn't close. Number one, price and volume. But when you start to see other signals, those secondary signals start to pile up, that's when you start to think, okay, I'm starting to get a little bit more risk in the market. So that's the way I use the MACD or the PPO. I used to use the MACD. PPO is the same thing as the MACD, for those of you who are wondering. It's the only difference is that the MACD takes the 12-day or 12-period, 26-period moving average and takes the difference in terms of dollars. The PPO looks at the 12 and 26-period EMA and calculates the percentage difference. So if you wanted to compare a stock like Chipotle, which is over $2,000 a share, to something like Sirius, which might be $5 stock, you can't look at the MACDs because they're based on price. Of course, CMG's MACD is going to be much, much higher if both stocks are going up, because the difference to calculate the MACD is in dollar terms. But you can use the PPO to compare any securities. You can take that CMG and look at the momentum on CMG versus the momentum on Sirius, because it calculates the difference based on a percentage. So that's the equalizer. That's the big difference. Now, there's also a big difference in looking at long-term charts. The percentage works out much better than the dollar. I won't get into that now, but it's just going to give you a much better looking chart that you can actually evaluate. That's common sense. Let's keep moving though. NASDAQ 100, you can see we got close to that 17,000 level. That was the all-time high at the end of December. So we got back close to it, couldn't get through it. You can see just like the S&P, we're unable to move back to the upside here in the PPO. And so again, I'm just looking at this as much more slowing momentum. The IWM, I tell you what, there's a couple things I'm looking for here. I was trying to update my intraday analysis on the IWM for everybody for the show, and I couldn't quite get it done. So I'll try to have that maybe for tomorrow. But let me put some extra bars on here. Let's go out a few months. Let's just go out 50 trading days. So first of all, I don't think there's any question we have a flagpole. So this could be some sort of a flag. We also have clearly an uptrend. It could be some sort of a cup. So I could see a couple of things playing out. First thing I would say is maybe what we would see off of this uptrend is maybe there, maybe we come down into the mid 180s, hit the 50 days somewhere in there. And then maybe in February, we make another run back to the upside and perhaps put in a cup. That's obviously I'm thinking bullish thoughts. That's a possibility. I think maybe something that would take longer to develop, which I probably would give a little bit more, maybe I might be a little bit more confidence, would be maybe something like a neckline right there. So you come down, let's say this is the top, Here we put in, say, a left shoulder. So here you put in a left shoulder, come back up. We test that neckline. We put in that neckline here. And then we come back down, perhaps to put in the head. Maybe we get, I don't know, maybe something like this. Put in the head. Right there. Then maybe from there, we go up. Again, I'm just speculating. I mean, I like to try to look for patterns while they're emerging to get a sense of where I think the market could go. But maybe into early February, we get a little rise on the IWM back up to that 196.5, 197 area. Maybe we go up just slightly above. I mean, maybe from here, we get a move up. Maybe we do get that slightly higher right side of the neckline. And then potentially, we would come back down to maybe a neckline, maybe around the 192.50 area, something like that. And then after putting in what would be at that point a right shoulder, then maybe we get this breakout here, maybe later into February, and maybe sometime in March we go back up and challenge a high. I don't know. These are just a couple of patterns that I'm looking for. When I see an uptrend and I see a pullback, I start looking for still favor at this point, something like this. But we'll see. Take it a day at a time. Just wanted to point out a couple of patterns that we might see. Transports, you can see pulling back, might have some kind of a similar pattern after a strong uptrend. We'll kind of watch, see how that plays out. I wanted to mention the volatility index because if you look at the volatility index, and I'm going to bring the S&P 500 chart over next to it here. First of all, the S&P 500, notice how we kept going lower and lower in August. And all of these highs, when we would rise, we kept going lower and lower with the highs. Well, you would think the VIX, if you have lower and lower highs, the VIX should have higher lows, right? I mean, the VIX is kind of inverse to the S&P 500. But when you look at the VIX back over the summer, look at these lows. I mean, the lows were actually coming in equal or even lower than what we had seen previously, even though the market wasn't, moving back up to a high. So this was telling me that fear was coming out of the market even while we were in a correction, which is why I didn't believe it was going to continue to accelerate to the downside and was just waiting for a pullback. Now, I thought it was going to pull back maybe in late October to here. I wasn't really expecting a breakdown and, a sudden reversal right at that key date, October 27th close. That was the exact bottom, right where the most bullish period of the year starts. That's where we hit a bottom. But what I'm looking at now is I'm seeing the VIX moving back up, and yesterday got very close. I mean, we got futures down. I haven't looked at the VIX, but I'm assuming we're going to know in 2 minutes. I'm assuming the VIX is going to hit its highest level probably in about the last 2 months at today's opening bell. And from there, I mean, we'll see what happens. But when the VIX breaks out, anytime the VIX breaks out, I know this is just a short-term level, and I don't think VIX is going to go screaming to the upside, but it could go, to 15 to start. And I wouldn't be shocked to see it maybe go to 17. If we get a 3 to 5% correction, or not correction, but pullback, I could easily see the VIX moving back up above 15 and maybe even towards 17 before I would think the next rally could occur in the market and then see the VIX drop back down again. So watch the VIX. I think that'll be in the short term, something to keep an eye on. And if you notice that the VIX breaks out and is going up, market's going down, and then at some point the market keeps going down and the VIX doesn't continue to move higher, you're probably getting close to your bottom. Chart of the day. First thing I want to mention, we have a sneak preview coming out later this evening or this afternoon, starting at 4:30. This is open to the public, so you can register. No credit card. Just come on in. But go over to EarningsBeats.com, hit that. And if you want to follow more of what we do at EarningsBeats, subscribe to our free newsletter, EarningsBeats Digest. Name, email address, hit the subscribe button. Again, no credit card required, and you can subscribe it or unsubscribe at any time. All right, OZK. I wanted to pull this up as the chart of the day. This is one that AD line is okay. I mean, it's pulled back a little bit with the selling, but not a lot. And also, I wanted to show you that the bank OZK, ticker symbol OZK, has been outperforming banks. And just a month ago was at a recent 52-week high relative to the banks. Now it has pulled back, but it's pulled back on lesser volume, and it's actually moving back into an area between 44 and 45, which is where we see a lot of price support. Notice the 50-day moving average is right in that area. So watch for this OZK to see if it bounces off this area of support. A lot of volume came in on this move from 44, 45 to the upside at 52. I would expect to see buyers back in somewhere around this 50-day moving average. And OZK reports, and I believe they report after the close today. But actually, I can pull that up real quick. Yeah, January 18th. So that's actually tomorrow. Sorry. So tomorrow after the close, OZK will report its earnings. It could be reporting while it's sitting on a major support level after showing leadership. That tells me they probably have a beat. Probably more likely than not. I think this bank reports an earnings beat over and above consensus estimate. And I wouldn't be surprised if revenue tops as well. We could see a gap up and a return possibly back near that 52 level if the report comes out as I would expect it to. And if we start to see the banks, which have been pulling back kind of like the IWM, if we see the banks get down to or near a solid support area and move back to the upside, this is one of those banks that could lead it back to the upside. So I like the chart on Bank OZK. We'll see whether or not it matters when the company reports tomorrow. All right, let's take a look at the opening bell. The market just opened. We do have small caps down 1.38%. The Dow down 1/3 of 1%. NASDAQ down 1.24%. NASDAQ 100 down over 1%. So maybe we're getting a little bit more rolling over, not just in small caps. And another thing that'll be interesting is if the S&P and NASDAQ start to finally roll over, do all areas sell off, or do we see the underperformance in the IWM? Do we see rotation from the bigger stocks back to the smaller stocks? That'll be something interesting to watch here over the next week or two as well. Anyhow, that's it for me. Appreciate everybody tuning in. Make sure you come and join us this afternoon for our sneak preview of Q4 earnings. Also, be sure to like our video and subscribe to our channel. That'll certainly help us a lot, even if you can't subscribe to our service. Obviously, subscribing to our service helps us very directly, keeps us doing what we're doing. So we certainly appreciate all of our current full service members, and we'd love to have a lot more joining us. Have a great day, everybody. Happy trading. Live trading room here 30 minutes from now. See you then.